Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris Rapeseed, Winnipeg Canola, and Malaysian palm oil.
Paris Rapeseed. Now, the market's high back in January, whilst making new higher prices, still had some issues. The closers were the ones to watch, and they all closed, as they had back in late November last year, below the March 23 high at 540 3/4. All this action turned out to be a triple top, with the January high itself being a horn top, and we subsequently moved lower. 8 weeks ago, prices were once again held up by the medium moving average, currently 506 1/4, but with changeover we had a big gapping move lower. Originally the gap was 490 even to 509 3/4. Now, this was not the largest gap that I've ever seen in this market, but it was useful enough, such that prices opened after it below the long moving average, currently at 494 1/2, and below two important supports. What was then the significant February 2024 to date uptrend, since reassigned lower, and that's currently at 452 1/2, and also the neckline extension, currently 487 1/2 of the April to August 2024 head and shoulders top, plus back then just above the bright green neckline extension of the August to September 2024 reverse head and shoulders bottom, currently at 479 even, which today, in fact, this week we have been testing, but from the underside. Anyway, back then in early through to late February, prices started to recover upwards and tried filling in the large gap overhead, which they very nearly did. However, despite moving up over the long moving average, the market over late February stalled and ended up forming a small double top, what turned out to be a larger mid-January to mid-March bearish half hesitation, dropping down 3 weeks ago down through the primary and secondary targets for this small double top, and last week reaching the target zone below for the bearish half hesitation. Now, for the earlier triple top idea, I said 4 weeks ago that, and I quote, "This pattern, though not a very pretty one, does give some potential targets below, of a primary target down at 480 and a secondary hard reach target X1 down at 458. Now, the move lower 3 weeks ago down to 481 3/4 had just about reached the primary target zone down at 480, enough for me to consider it reached." End of quote. I can add to this that 2 weeks ago prices continued the move lower, reaching the secondary target X1 at 458. Last week we tried even lower on the Monday, but after forming a hammer pattern that day, a pattern traditionally seen as a bullish reversal pattern, we have seen a swift and somewhat remarkable recovery, such that we already encompass all of last week's actions and were set up for at least an outside week pattern and possibly a weekly key reversal. In the end, the market settled for a lesser outside week, and we have this week moved higher still, filling in the March gap. In the process, I said last week about the move up that for a weekly key reversal up, and I quote, we would need a close on Friday over 478 1/4. As this is so close to the bright green neckline extension, I would ideally like to see a close over the bright green neckline extension, as I say, currently at 479 even. Is this doable? The answer is yes. But the congestion we have seen in the past as prices approach from below the 470 even area overhead, and here I am referring to what we saw in August and September last year, well, it does raise a question mark as to whether the market can fulfill the obligation for such a weekly pattern. End of quote. As I've mentioned earlier, the market was not able to fulfill that task, and what I note this week is the topping action of the bright green neckline extension, especially on a closing basis. Winnipeg Canola. From November last year until late February this year, the market started, for the most part, a 3 steps up and 2 steps down action, gradually moving higher. This overall action higher left us with an important bright green December 24 to early March 25 ascending wedge pattern. 4 Fridays ago, the market closed below the lower trend line for the first time and started the resultant move lower. From this pattern, accelerating the fall with a gapping changeover between 634 down to 615, which still remains open. For this move down, I laid out primary, secondary, and even a tertiary target. All were reached, and the market was seemingly stopped by a combination of the lows at 567, 571, 180, and 575 even, plus the dark blue neckline extension currently at 564.10 of the April to June 2023 reverse head and shoulders continuation pattern. Now I'd possibly throw in the September 2024 low and pipe bottom at 553.5 and the October 2020 high at 552.80. We didn't reach these, but their proximity and market actions on approach to these suggested a swift and immediate return for prices higher. However, the recovery higher has been slow and nowhere as high as we've seen elsewhere in other markets. There is no weekly key reversal or even the lesser outside week opportunity here. The reason is because overhead we have the previously mentioned 50% absolute Fibonacci line at 606.90, and this might well put off any further significant attempts higher. However, the action over the last 3 weeks does suggest the construction, or at least hints at the possible construction of an ascending wedge pattern, possibly even an ascending triangle. We shall see on that, but it is worth paying attention to if we do go down this route. Bursa Malaysia crude palm oil. I said here 24 weeks ago, and I quote, "Of all the oil seeds and veg oils, palm oil has been the toughest to decipher in recent days. There's been a lot of activity and the changeover gaps, most notably in mid-September, have been a great hindrance. However, there have been 2, possibly 3 patterns here that have influenced the market and seem to have captured it somewhat, at least since April." End of quote. Okay, so things have developed since then, but a good place to start is to look at those earlier patterns highlighted so many weeks ago. The first of these patterns is the bright red neckline, currently at 44.58 of the September to November 2023 reverse head and shoulders pattern, which I've highlighted repeatedly and which even 3 weeks ago and last week supported the market. However, we are today pressing, if at the same time pressing, today we are pressing below, if at the same time pressing the bright red neckline from below. Now, additionally, and this one I added a few weeks ago and many times previously, is the dark blue neckline, currently at 44.78 of the September 2015 to November 2017 head and shoulders top. I had not been sure about this one in the past, but as it was an old one, a super old one, that had been way below the current market, but similarly to the bright red neckline, had in recent weeks significantly supported the market, even if it seemingly gave way this week, and we are now below it. I would still consider it for now. Please continue to bear both of these in mind. The third pattern here is the very slowly rising gold long moving average, currently at 43.68, that stopped the market's fall dead in mid-January and has truly acted as a base for the recent rise in prices between January and February. This week it is seemingly trying to repeat that feat, with prices halting there this past Tuesday and Wednesday. Now, there are other, newer and closer to market features to watch out for. And to start off with, I'd look to how the market has dipped into a wide congestion zone between 44.08 to 45.59 and now seemingly pulled back into it again. Within this congestion zone, we have the old March 2008 previous all-time high at 44.84, as well as the April 24 high at 45.27 and the June 22 low at 45.59. This congestion zone helped hold up prices 3 weeks ago, last week, and may be doing the same again this week as well. Next, 6 weeks ago I outlined the mid-August to mid-January 2025 bullish Andrews picture, which 2 weeks ago I discussed finessing into a shallower, what we have now bright green bullish shift picture, you can see on my daily chart, for the same move as I did last week. Now this week we have on Tuesday and Wednesday dipped below the lower time, currently at 44.08, closing consecutively below it, but today we've pulled back above it. This nevertheless puts this pattern on notice of retirement. Next, a pattern emerged over the last few weeks, but it is very much dependent on 2 things. Firstly, this is something I see on my daily continuous charts. So if you disagree with daily continuous, and I stress that word, continuous charts, well, you won't like this or what I say about it. And secondly, the last 5 weeks' actions have not helped draw this possible pattern. And I'm on the verge of recognizing it but discounting it as well. It's a January to February based reverse head and shoulders pattern with a neckline currently 49.57, that's above the market. Finally, this week I have drawn a mid-February to early March nascent, mildly bearish shift pitchfork, highlighted in pink on my daily chart. More acute, bearish Andrews pitchfork, this move does not work. So it's very much this or retiring it completely, which I'm quite prepared to do. This week we have seen the market test the lower time, currently at 43.64, and hold. But as this is coincident with the gold long moving average, I do not feel comfortable allowing this bearish pitchfork to take the credit. It may have contributed, but it was not the reason solely why prices rose. Interestingly, the middle time above, currently at 45.35, is entering that congestion zone I spoke about earlier between 44.08 to 45.59.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.